Imagine this, a single statistic, the unemployment rate, has the potential to sway the entire global economy. Sounds dramatic? Let me show you why it's not. Labor market data, like the unemployment rate, is more than just numbers on a spreadsheet. It's the heartbeat of the economy. When it rises, it signals trouble. But how exactly do these numbers influence inflation, interest rates, and even the prices you pay at the store? Today, we'll dive deep into the fascinating world of labor market data and uncover how it drives everything around us. Stick around, because by the end, you'll see how these invisible forces are shaping your life in ways you never imagined. The unemployment rate is often the first indicator economists check to gauge the health of an economy. Why? Because when unemployment rises, it means fewer people have disposable income to spend, and that's where the ripple effect begins. Think of it like this. Fewer jobs mean less money circulating in the economy. Retailers see declining sales, businesses cut back on investments, and economic activity slows down. It's like a single domino tipping over, setting off a chain reaction. When people lose jobs, their purchasing power drops, and with it, the demand for goods and services. This decline forces companies to scale back production, which leads to more job cuts. It's a vicious cycle, but it doesn't stop there. A weak economy also means that GDP, the total value of goods and services produced, shrinks. A shrinking GDP sends warning signals to investors, eroding confidence in the market. This lack of trust can trigger a recession, affecting everyone, from large corporations to individual households. This is where things get even more interesting. Central banks, like the Federal Reserve or the European Central Bank, closely monitor labor market data because of its direct impact on inflation. When demand in the economy weakens due to high unemployment, it often creates deflationary pressure. Prices start to fall. While this might sound good for consumers, it's bad news for businesses. Falling prices mean shrinking revenues, which can lead to even more layoffs. On the flip side, when unemployment is low, it can indicate an overheating economy. Rising demand can push prices up, triggering inflation. Central banks respond by adjusting interest rates, raising them to cool down inflation or lowering them to stimulate economic activity. You might be wondering, what does all of this have to do with me? The answer, everything. Labor market data directly influences everyday aspects of your life. For instance, when central banks raise interest rates to combat inflation, borrowing becomes more expensive. Mortgage rates climb, car loans cost more, and credit card debt grows. Even if your income remains steady, your expenses increase. At the end of the day, labor market data is much more than numbers. It's the pulse of the economy, a signal that can trigger waves of change. A small shift in unemployment can set off a chain reaction, impacting inflation, interest rates, and the global economic balance. If you found these connections as fascinating as I do, make sure to subscribe to our channel. Here we uncover the hidden forces shaping your world so you can better understand and navigate them. Don't underestimate the power of these numbers. They're shaping your life every single day.